Okay, some admin stuff before we start with the chapter. So this is where we are, November the 1st, believe it or not. I'm sure you guys are tired enough to know, right, that it's already November and that the semester is about 5 weeks away from being done. So we have more semester behind us than in front of us, because the last day of all the classes this semester is the 8th of December. So we have literally 5 weeks or so to go. What's happening today? Today, the chapter 10 homework is due. I mean, we've discussed that in the past, but just a reminder that by 6 p.m. today, your homework for chapter 10 is going to be due. That's all the stuff to do with asset acquisition, the interest capitalization. We finished up last week, Wednesday. So hopefully, well, not hopefully, you have everything, or you have had everything you needed to be able to finish this homework. I do have office hours today at 1 o'clock if people have any last minute concerns about anything, but especially the homework since it's due. If you need help, feel free to pop in. You can also email me. Obviously, I mean, with the email, I may not be able to answer immediately, so just bear with me if you're asking me last minute. 4 o'clock for something that's due at 6 o'clock. I may not be right in front of my email, looking at my phone, at that minute. So bear this in mind. Again, every homework counts 3% towards your overall grade. So even if you can't finish everything, try to do something so you at least get some points in the bag. Then for those who do want me to read their work before the final submission of the term paper, tomorrow at 6 o'clock is an optional, an opportunity to do the optional submission of part B of the term paper. I'm only accepting the stuff tomorrow. I'm not going to accept any papers between tomorrow and the early submission deadline, which is the 17th. So please don't ask me, the 3rd or the 4th or the 5th, if you can still send something that I can read. This is planned out so that I can read things and still return it in time to people to make the changes and put their work together if they want to do the early submission. So if you haven't completely finished part B, that's okay. You can send me whatever you've written and I can read what you've written and I can give you comments on the part that's still to be written. I mean, I'm not saying send me a paragraph and then in the hopes that I'll tell you what to write for the rest, but it doesn't have to be complete, the draft. So if you have something, feel free to share it. I know at least one, maybe two people have shared. If you have shared it with me, just during the break, confirm that I did see it. I know that Jaron shared something. I don't know if anybody else did. So during the break or in the chat, just let me know, because I return people's stuff via Google Docs, and I think some people are making their changes, and I'm not sure if they're also adding on part B and expecting that I would see that. I don't necessarily know that that's happening. So if you are planning to submit or you have submitted, just double check with me that I'm actually seeing your submission. Okay, so today we start with chapter 11. As discussed, we'll probably go for about 3 sessions or so, and then you'll have another homework due fairly quickly for chapter 11. And then at that point, this is where we start again with the next round of testing. So November 11th, I'm just pointing out dates so that people are aware of the dates. November the 11th, the window opens up for the test that's going to be on chapter 10 and 11, and then it closes a week later. And you can, as said before, you can do the test and the quiz at any time in that window. The people who are planning to submit early for 5 extra points on their paper, you'll have to manage your time so that you are able to do that and still complete the test, or you're studying or whatever in time. You don't have to submit early, guys. I'm trying to give an early submission option so that I don't have to penalize for late submission, right? I'm trying to use the carrot instead of the stick to say, I'll give you bonus points if you submit early, because I don't want people to run late and submit late, because then I have to start ticking off points, and I don't want to do that. The final submission for the paper is the 24th of November, which is about 3 weeks away. So there's still time. Remember, this paper is only 4 to 6 pages. All right. I think the hardest part is getting hold of the annual report and making sure that you are on, like, looking at the questions and answering them and so on. If you need help with the paper, you can also come to office hours for that. If you need more like grammatical and structuring sentence help, you can go to the writing center for that. But I'm always available to try and support you, but don't leave this till the bitter end. This is before Thanksgiving, so that you guys can go and enjoy your Thanksgiving, and I will sit and and read papers until I'm blue in the face, right, over the Thanksgiving weekend. And then on that Friday, and I guess not as much enjoyment of Thanksgiving, sorry, but I put the chapter 12 homework due on that weekend, because I know some people will be picking up extra shifts at work, but maybe some people are actually home and able to maybe have at least one day free on Thursday or Friday or whatever. I mean, you spend time with your family, obviously, but some time free to finish this homework. And then, yeah, then we're rolling into the end. The due dates become, the chapter 13 and 14 are small, so the due dates are fairly close together. The last homework is due on the last day of class, and then we open up final, and the final is not cumulative. The final is on chapter 12, 13, and 14. I'll give you a prep sheet and all of that. You test in a window from the 9th of December to the 13th of December, whenever you want to finish your test or your final exam. Excuse me. There's no quiz for the final, so just the exam within that time frame, and then I'll carry on to collate the grades and so on. All right. So does anybody have questions about where we are with dates and times and anything that needs to be clarified further, or are we all clear on the dates and when things are due, especially that there's a homework that's literally due today, which we had discussed last week, Wednesday, but it would have been up to you to mark your calendar to make sure that you were doing it. Any questions? All right. Okay, so, even with the final, I tried to give you a window, because I know that sometimes, all the finals end up happening on the same day or between 1 or 2 days, and I want people to at least be able to have some time to study. So hopefully that helps you. The last day to withdraw from any course, I'm not saying you need to withdraw from this class, but I'm just saying the last day to withdraw from any course, if you are feeling like you're headed, in a bad direction and you don't want your GPA to get messed up or whatever the case may be, is December the 8th. But you have to be careful, like, don't, there's, there are things that if you decide to just stop attending a class or something like that without speaking to the professor or without officially withdrawing, then all manner of things can go wrong, because the professor may or may not realize that you're still attending. This class is fairly small, so I know who's in the class, but some classes are a bit bigger and people may not recognize that you're not attending. So if you feel like you need to withdraw from a course for whatever reason, obviously speak to someone, speak to your advisor. You can even speak to me about what you're struggling with. And what makes sense, but make sure that if you really are serious about withdrawing, that you actually officially withdraw from the course to get the W grade before the withdrawal date. Because sometimes people, people may not, like I said, they may not realize what's going on with you or whatever, and you don't want to end up with a grade in the class that is not reflective of your best work because you forgot to withdraw or whatever. So that's just a word of warning to the wise. Hopefully no one's in that situation. My usual plug: registration is open. Please register. I can't tell you, how important it is if you want to get the classes that you need to graduate. If you are trying to stay fully online, the offerings for online are much less than they were before, because CUNY administration has asked us to offer more in-person classes. I think there are no math classes that are online. If you need a math class, you will have to come onto campus, in the spring, if that's when you need it. Please note that if you register for in-person or hybrid classes in the spring, as of today, the guidance is that you can register without having your proof of vaccination in the system, but your proof of vaccination will have to be in the system by 10 days before the classes start. Otherwise, you will be dropped from the class. So classes start on March the 5th for the spring, but you will have to be fully vaccinated and have your information up in the system. I would aim for sooner than the middle of February. I know that sounds far away, but people may register and then forget to get vaccinated and forget to upload the stuff. If you're already vaccinated, but you haven't uploaded your information because you haven't needed to, because all your classes are online, I highly recommend that you just upload your information anyway, because that allows you to, have the access to the campus in case you maybe need to stop by on campus for something. Easily access campus, because they're only allowing vaccinated students on campus unless you have a religious or medical exemption. Additionally, you don't have to then think about it when the time comes and you're in danger of losing your classes. And remember, this is guidance today. Things are so much in flux because of the, just the nature of COVID, and just people are, making decisions as things come up. So I wouldn't wait until 10 days before classes, because they may change the guidance and say that it now has to be 21 days or something like that. So if you are comfortable being vaccinated, don't wait until February to get vaccinated and then find out that you are not considered fully vaccinated to have your stuff loaded into the system. And again, see which classes you need. If this is not your last semester, see which classes you need and make sure that they're actually being offered when are in-person classes. Oh, they were. Oh, is that Anthony that's asking me? Anthony, the in-person classes actually started effective last week, Tuesday, October the 26th was the first day that students were coming into the campus for classes. Of course, if your class didn't meet on a Tuesday, then you would not have, needed to come. But from Tuesday onwards is in person. So say your class meets on a Monday, you wouldn't have come last week Monday, but you would be expected to be on the campus this week Monday for the class. I don't know. I hope I'm answering your question, and I hope if you do have an in-person class, that your professor for that class has been in contact to let you know where and when you guys are meeting. If you are having any issue with that, please speak to me, because I can try to help you to contact the professor or the department or whatever to figure out what's going on. But last week, Tuesday, October the 26th, was the first official day for in-person and hybrid classes to start meeting. So anybody who has an in-person or hybrid class, make sure that if your class is meeting on the campus, because you need to be there, right? It's a little bit chaotic, right? So everyone's still trying to figure it out. Make sure that, if you were supposed to put in your vaccination stuff, that you did do that, because as of last week, Thursday, I think, maybe Thursday or Friday, CUNY officially withdrew students, an administrative withdrawal of students who are registered for in-person or hybrid classes this semester and did not submit any proof of vaccination. They were withdrawn, and I got, I'm not teaching in-person or hybrid, so I don't have the experience to tell you what happened, but I did speak to one of my colleagues who's teaching an accounting class in person, and 5 of his students ended up with a WA and are not able to continue with the class. He didn't have any warning, just between 1 week and the next 5 students were withdrawn, because that's something that's happening at CUNY Central. That's not something that the professor is doing, but the professor can help you if you say that you're still trying to get your documents into the system or whatever, speak to your professor or speak to me. Anybody I shouldn't say anybody will try to help, but I will try to help you, even if I'm not the professor of that course, because I'm deeply concerned about students finishing and graduating, and many people are, especially in light of all these changes. All right, so make sure you're registering for the spring, because classes will start filling up, especially online classes. Because I can give you an example. I'm teaching one class online asynchronous in the spring, and it has 12 students in it. And the same class in person has 5 students, which tells me that a lot of students are still looking for online because they're probably working or whatever. And that means that if you wait to register, you could end up only finding an in-person schedule. And if that's not what you want, then there's nothing that will probably be done, because the school has low-ish or lower enrollment, and they're not looking to add classes before the classes that exist are actually filled up to at least 19 students. And so you can't go to a department and tell them that you want an online class for history or whatever. They'll just tell you that that's not going to happen, and you'll have to come in person. And that could have implications for childcare, it could have implications for work, it could have implications for your health, etc., etc. So act quickly. If you have questions, speak to me. Make sure you're speaking to your other professors if you are in person or hybrid classes, to ensure that you are where you need to be if you actually have to go back to campus. And if you are having some difficulty with returning to campus, talk to me. I'll try to help you. You guys belong to me and my department because you're business majors. So it's it's within my calling to make sure that you have everything you need to try and get you graduated. All right. Are there any? I know that was long and it's taking up a lot of time, but guys, I feel like we could have gone on with the material, but if people are being left out, like taken out of classes, or people don't know what's going on, then it doesn't matter if I'm going into accounting mode. You still have concerns that maybe aren't being addressed. Is there anything else, any other question that somebody has about anything that I just discussed, from the schedule right through to vaccines and registering for the spring? Anything else that is on your mind that you want me to talk about? All right, we seem fine, and I'll just say again, if the semester, I mean, if next semester is your last semester, last 12-week semester, just make sure that you also register for intent to graduate, so that the registrar knows that you're planning to, or that you think that you've done everything you need to do to graduate in the spring. All right. Okay, so we start with chapter 11, which is, there's somewhat a little bit of relief from the complications of chapter 10, because in chapter 11 we start with depreciation, which is at least something just to a large extent that many of us have encountered before. And what happens in this chapter is that we're basically looking at subsequent measurement, as as the codification calls it, of these assets that we just acquired in chapter 10, right? So chapter 10 was all about buying the assets, building the assets, interest capitalization, goodwill that comes out of a business combination, whatever the case may be, all the different assets that we could acquire. Chapter 10 is about how we measure them after we've actually acquired them. So we look at depreciation, which is, for fixed assets or property, plant, and equipment, right? That's depreciation. We also look at depletion, which is for natural resources. So it's kind of like the depreciation of natural resources. It just has a different name, and we'll see how to calculate that. We also look at amortization, which is cost allocation for intangible assets. So it's like the depreciation of intangibles. The name is just different. And then we also look at impairments, which is not depreciation. It's kind of looking at when an asset, whether a property, plant, and equipment, or an intangible asset, when it has a loss in usefulness that is kind of unexpected. And so you can't just keep depreciating. You actually have to look at whether you have to recognize some type of loss, because your expectation of the amount of, I guess, cash that that asset was going to generate for you is different from when you initially recorded the asset. So we will consider that. There will also be, just by way of overview, there will also be discussions on what happens if we need to change our estimates for depreciation, what happens if we need to change our depreciation method, what happens if there's goodwill that's impaired. That's a pretty big topic that we have to deal with. And a few other things here and there that aren't that major, but they form part of the chapter. So if you look at the chapter over here, the when we started, you can see all the learning objectives. I'm not going to go through all of them, but this is basically just talking about everything that I kind of just mentioned. We don't go too much in this class about the difference between GAAP and IFRS. It's outside of the scope of our work, in comparing GAAP to international accounting standards. So when you're reading, you can read that, but I'm not going to, test you on that. But we certainly are going through all these topics, including this last one, which is, subsequent expenditures. So if you have repairs and maintenance or additions, improvements or rearrangements of the asset. I noticed that I probably have a legacy, what do you call it, title here. So, we'll go with property, plant and equipment and intangible assets utilization and disposition. That's fine. I can I can change that, but I'm not going to spend time doing that now. So what is depreciation, right? That's the question of the day. What is depreciation? If I had to ask someone on the street, just stopping them, or even maybe some of you, you'd hear often that people will say, well, depreciation is when something loses value, right? That's often the first go-to. I'm sure even though I can't see you guys, some of you may be nodding and saying, yeah, that's what I also think, that depreciation is a loss of value. So in strict accounting terms, that is not how we think of depreciation. It's, yes, something does, there's life where they kind of say, to you, like a car is depreciating asset, because as soon as you drive it out of the dealership, it's losing value. Yeah, I mean, there's the loss in value, in the sense that if you were going to sell the thing, in a year's time or whatever, you're going to get less money for it than what you paid for it maybe, last year. But that's not what depreciation is about. If you think about assets, versus expenses, we know that if we have an expense, it goes through the income statement immediately. And so it decreases our profits, in the period in which that expense happens. Whereas when we record something as an asset, it goes onto the balance sheet, right? So it's not going through the income statement. But as we use the asset, we have to in some way account for the fact that the asset is being used, and that is some type of expense, right? And an expense is, if we go back to basic definitions, right? An expense is the cost of an asset consumed or a service used in the business. So if you start thinking about, like, maybe a building that we have, that is an asset. We're not going to expense it on day one and put, $1 million through the income statement. We'll capitalize it, right? That's the word, capitalize it, to make it an asset. But over time, we have to recognize that we're using the building to generate revenue. So that falls within the definition of an expense, right? The cost of an asset consumed or service used, in this case, an asset consumed. So the book starts out by making the point that I'm just discussing here. Depreciation is not about valuation or value loss of the asset. It's about allocating the cost of that asset that you put in as an asset, allocating the cost over time to the income statement, to expenses, to basically what we refer to as, in a way, you're matching the the cost related to the use of the asset to the revenues that the asset is helping you to produce. All right. So depreciation is about cost allocation of the asset, right, to expense over time, right? In a rational, meaning, it makes sense, rational and systematic manner. There's a system, so someone who is looking at what you're doing is able to predict, what the next year will look like. To those periods expected to benefit from the use of the asset. So when I buy this building for $1 million, I'm not saying, oh, I'm only using this building in 2021, so I'm going to expense the whole thing. I'm going to say the useful life of the building is maybe 20 years. And so I will be systematically expensing that asset over 20 years, and that expense will, offset some of the revenue that's generated by the fact that I'm conducting business out of that building. So, if we look at what comes up in the book, they give a fairly basic but a nice example of the fact that depreciation is cost allocation. They say, there's a truck that's cost $8,200. It has a salvage value. They just say that it can be sold for $2,200 5 years from acquisition, but this $2,200, the terminology for that is that it's a salvage value. And so this 2,200, since we can recover it at the end of the life of the asset, this residual or salvage value, we won't depreciate that amount because we don't have to expense it since we will actually receive it at the end. So what we do expense and allocate over time, right, to the income statement is the cost of the asset minus the amount that we're expected to recover at the end. So $6,000, right, becomes what we call the depreciable base of this asset. That's what we will allocate over time. And so we go year 1, 2, 3, 4, and 5. So it's a 5-year useful life. So 6,000 divided by 5 is what you will expense, right, over time. And so the book, talks well about how, the truck's cost is allocated into expense in those years in direct proportion to the role the asset plays in revenue production. They won't say matching anymore because matching is kind of like I don't want to say outdated term, but they try to move away from it a little bit. But that's basically what you're doing, right? You're aligning the expense to the revenue that it's producing. But just think about what you're doing, right? Think about what we're doing. We're really engaged in making a lot of estimates, right? We don't actually know for this truck that this is how the truck is going to be used. We're just making, to a large extent, right? We're making assumptions that if we say 6,000 divided by 5, so $1,200 is being expensed every year. Does it really mean that we, used up a fifth of the truck every year to generate revenue? Obviously, the truck is still there. A fifth of the truck is not falling off, but we're saying, as we expense the asset, is a fifth really the right answer? It's an estimate. Okay, which means that it's probably not 100% the right answer, but it's the best information that we have. So, the book contrasts that with like prepaid rent, where or is it prepaid rent? Yeah, prepaid rent, where that the rent is $2,000 a month and you pay the rent 2 years in advance. So that the expense every month is accurate because it's based on a contract, whereas, depreciation is based on estimates that we make. Think you're saying at the beginning of the 5 years that you'll get 2,200 at the end. That's not necessarily the case, right? Circumstances can change. Also, you're saying that you'll be able to use the truck for 5 years. You don't know that on day one. Something could happen and you could realize that the truck would actually be used for 6 years or 7 years. So before we start doing, any of our examples and so on, just remember that depreciation is an estimate. Or is dependent on estimates of the residual value or salvage value of the asset, the useful life of the asset. It's not about a loss in value. It's about allocating the cost of an asset that we did not expense initially, right? And allocating it over time so that it's in direct proportion to the revenue that the asset is generating. So, further on in the book, they do talk about how the asset may have a loss in value because you can sell it for less, after 1 year, but that is separate from the cost allocation for depreciation. And then, of course, as I said before, depletion is for natural resources and amortization is for our intangibles. And so keep all those things in mind. As I said in that example, the depreciable base was the 6,000, right? The 8,200 minus the residual value is 6,000. That's the base that we use. That's the base that we use to depreciate. The useful life in that example for that asset was 5 years. And the method, based on what I was saying, and you may remember this from accounting one, I don't know, or maybe some other accounting experience, the method was the straight line method, because you're basically just saying the asset is being used evenly over 5 years. And we'll go into methods in a minute here. And these are the estimates that are required, right? The salvage or residual value is the estimated amount that you receive at the end of the life of the asset, or when you remove it from service. And the useful life is how long it's going to stick around. Any questions or comments on? I know it's like the start of the chapter, so it's a little bit dry because I have to do a lot of talking. But anybody want to ask me anything? Okay. So what are some of the methods here? The book talks about time-based methods or activity-based methods. That's fine. And that's kind of how this works out. You have, again, the methods are kind of set. You have to choose between, different methods of depreciation for your assets. I wanted to show you this one example. This is one of the companies that we have in our list of companies for the paper. This is the property, plant, and equipment footnote for Peloton. They have all these different types of assets: land, leasehold improvements, buildings, machinery, equipment, even software. Remember, you can capitalize some internally produced software once it reaches technological feasibility. And so they have all their property, plant, and equipment. They've got more than doubled the amounts between 2020 and 2021. That doesn't surprise me because their business grew a lot during the pandemic, with people no longer being able to go to gyms or choosing not to go to gyms because of COVID. And so they also have an increase in the accumulated depreciation, applying to all the property, plant, and equipment, and the amortization applying to the software. But what I wanted to also say was, they tell you in their notes here, what are the estimated useful lives of the assets that they have, and so they show that. And I guess people who want to go and recalculate or recreate these calculations could try, but the point is that these items that are being discussed are also shown in these financials. And then when we talk about, and I'm just going to try and go back up here, hopefully it's not going to be too painful to do this. They also have a footnote where they discuss the accounting policies, and let me just see that I don't go past it. The impairment, property and equipment. They tell you that it's stated at cost less accumulated depreciation, and depreciation is calculated using this straight line method. And a lot of companies, you'll find, they just go for straight line. Does anybody want to guess why let's have someone other than me talking? You want to guess why many companies just go for straight line method as their method of depreciation? Wild guesses are welcome. Why would you choose straight line? Or do you first want me to remind you what straight line is? Okay, I'll hold the question until we go over straight line, and maybe then it will become clearer. All right. So different methods that the company can use. You can do an activity method, which means that the depreciation is based on how much work the asset actually does during the year. This is typical for like a vehicle, because you can measure the activity in miles, or a machine where you can measure the activity in output in terms of the number of items that the machine is producing. And so, this probably, I would say that this method is very accurate in the sense that it's actually basing the depreciation not just on an even amount that's being recognized over time, but on the actual use of the asset. But you have to be careful here, because if you have a building, for instance, it's going to be very difficult to find a unit of activity or a unit of production for a building. It's more likely that a building should be depreciated over time as opposed to units, because there isn't really a unit, that I mean, if you think about how many people are coming in or out, that's still not really a thing. So a lot of this units of activity, the life of the asset is, considered in terms of output or activity, and it often applies to things where you can actually measure output or activity. Like if someone's driving a Lyft or an Uber or a taxi, it's very easy to see how many miles, right? So now if you think about 2020, from March to, maybe even into the next year, but let's just say from March 2020 to the end of the year, if you were doing the financials of an accounting company, or you were doing your own financials and you drive Lyft or Uber, there was a dramatic decrease in the amount of people who were, riding in these ride shares, because people were, on lockdown. So in this case, something like a units of activity would immediately show that there is a decline in activity, so the depreciation expense gets smaller. The same would, apply to maybe some of the public transit that they took trains out of service or whatever, because there's so few people riding the subway. And in that case, again, there's probably if they were using units of activity, which I'm not sure what they do at the MTA, but there would be a smaller depreciation expense. So if you think about units of activity, maybe just think about, the COVID lockdown time, that a company would then, since they're also not generating a lot of revenue at that time, they also have a smaller expense, which kind of helps with this, lining up the revenue and the expenses. Straight line method is just, like it's the name, one straight line. The activity method can go up and down. Straight line is just one straight line. The same amount of depreciation is being expensed every year. It's a widely used method because it's easy, right? You're just saying 40 years for the building. Every year, I'm just expensing 1/40th, unless it's a partial year, which we'll get to, but I'm just expensing 1/40th of the depreciable base, and that's it. Depreciation also then is the same amount all the time, which is convenient, because you can, if you're working in QuickBooks or something, you could actually set up automatic journal entries to just go off at the end of the year. Everything, can be automated. You don't have to run around trying to figure out mileage or whatever the case may be. So it's definitely easier. But there is a massive assumption that the asset is as useful every year as every other year, right? So again, think about COVID lockdown. There were probably, buildings, just like at LaGuardia, there were buildings that were not being used at all for over a year. But if they're on straight line depreciation, even Peloton that I was just showing, right? Peloton has its flagship showroom and studio, I should say, not showroom, but I guess both. It has flagship studio in New York City, but no one was coming there because no one was coming to cycle together because everyone was at home. So if that building is being depreciated on a straight line method, you still take the entire depreciation for the year, even though the building basically wasn't used. So in that case, straight line is not as accurate, right? Because it's not showing what actually happened. It's just showing a constant charge every year. But it is easy, and you are allowed to use it like that, even if the situation dramatically changed. The thing where the company doesn't benefit from that is that they'll have a big depreciation charge. Because it's the same depreciation charge every year, but they won't have as much revenue to offset against the expense because the studio isn't open. But people who read the financials would know that these types of things exist. So more often than not, like financial analysts are not going to penalize the company too much because they understand that depreciation is an estimate. Okay, so think now again about the question I asked: why does Peloton use straight line method, and why do many other companies use it as well? Then you've got the last one. The last type of depreciation is what you'd call accelerated methods or decreasing charge. However, it's basically also based on time, but it is charging more depreciation at the beginning of the life of the asset with less depreciation happening at the end. And the implication here is, or we're trying to say that the asset has more usefulness in it at the start of its life than at the end of its life. So it's probably helping to generate revenues to a greater degree at the beginning than at the end. So we need to do accelerated depreciation at the beginning with big charges and then go down, right, go low at the end. These methods are also very popular for tax makers, and I don't know if for any of you who do taxes, they do like a declining balance type of method. It's an accelerated depreciation method. And they do come up in practice. So you do obviously need to know how to calculate this. And there, with the sum of the year's digits, which is one of the methods. This requires like some multiplication with fractions and stuff, and I'll show you how to do it. It's a little bit weird, but I mean, once you understand it, it's very easy to do. It's just initially it might look a little bit weird because of how we come up with the fraction that we use to multiply against the depreciable base. And then declining balance method you would have seen in an earlier accounting class if you can remember. If you can't, it's fine. Here we apply a percentage, right? So it's like double the straight line rate, or it just tells you 40% or 20% is applied to the asset's book value, not the depreciable base, but the book value. And book value is defined as cost less accumulated depreciation. And you don't include salvage value, so you don't deduct salvage value when you calculate book value, right? Because book value is defined as cost minus accumulated depreciation. So what happens with declining balance is you continue to depreciate until you end up at a book value that is equal to salvage value. All right, so usually the rate is some multiple of the straight line rate, double the rate, triple the rate, whatever. The question will tell us what to use. So those are the main methods. And like I said, if you end up working in taxes and things like that, you may also run into some of these declining balance type methods. Does anybody, I know people are like super quiet today, which is fine. I mean, it's Monday after all, and it's the day after Halloween. But does anybody have questions about any of these methods before I talk a little bit about partial periods? And then at that point, we will do examples. Anybody need me to repeat anything? Okay. So I'll just talk about one more thing here before we go into example mode. There's this thing called or this notion of partial period. So it's fairly reasonable that like even if you look at Peloton, they have, let me go up here. They have a June 30th, right? End of their fiscal year, whereas here's their property and equipment net, that's net of depreciation. It's so 591.9 in millions, so that's 591 billion. If I'm reading that right, yes, I think I am. And the intangible assets have also gone massive from 16 billion to 247 billion. And that is, I think a lot of that is around their development of their app and stuff, and maybe even some acquisitions and so on. So why am I saying this? I'm saying that a lot of these assets are not just miraculously bought on July the 1st, which is the beginning of their fiscal year, so that you can just conveniently depreciate for a whole year up to June the 30th. It's entirely possible that assets are being acquired throughout the year, right? So obviously sorry, I'm just curious. I just want to see something. Yeah, there's the research and development is huge compared to the previous year. So they've expensed a lot of their R&D, like we learned in the previous chapter, and then they've also capitalized some of it. So coming back to the point about when the assets are acquired, it could be at any point during the year, right? If the year ends on June the 30th, then it means it starts on July the 1st. So at any point in that 12-month period, they could have acquired assets. So if they don't acquire an asset exactly at the start of the year, then sometimes, well, not sometimes, all the time, they have to consider partial periods in their calculation, meaning that maybe they acquired the asset halfway through the year in December at some point, right? And so we have to be thinking about how many months an asset is used during an accounting period, because depreciation is a function of use, right? It's going to be an expense that is based on the use of the asset. So if an asset is purchased and not put into use, then you actually can't recognize depreciation expense, right? So if I buy, for my business, I buy a printer, in September, and I'm so busy that I forget to plug it in because there is some other old printer that we're still using. If December rolls around and it's the end of my calendar and fiscal year, and I haven't put the new printer into service, then I'm not allowed to take depreciation on the new printer, okay? Because you have to actually use the asset to depreciate it. We'll see later on in the chapter where assets are held for sale, they aren't depreciated anymore because they're not being used anymore, okay? So depreciation for partial periods, companies do all kinds of things to make their lives easier. All right. Sometimes they will say if an asset is bought, at some point during the year and not at the beginning of the year, we'll just depreciate for half a year in the first year and half a year in the last year of the asset's life, right? So you can do that. You could do some fraction. You could do what we would, we'll do in our examples, where you say how many months of the year was this asset actually in use, and just multiply by that fraction. But this is the point. All these policies, whatever they may be, whether you just depreciate for half a year, even if you bought the thing in November and your year ends in December, you depreciate for half a year at the start of the life and half a year at the end. You just have to be consistent. Okay, I think the FASB understands that depreciation it's a massive undertaking to calculate it if companies have a lot of assets. So they they understand that things are being purchased all over the place. I used to audit when I audited mostly banks and private equity and so on, but they did have property, plant and equipment, obviously, and you would have this what they call the fixed asset schedule, and you'd have dates when the things were bought and all kinds of calculations and whatever, and it got pretty crazy. So I think this helps companies to say you can choose how you want to treat the depreciation on assets that are purchased during the year, as long as you are consistent. For our purposes, we're just going to do 1 or 2 examples where the asset is bought at some point during the year and just use the fraction of however many months the asset is used out of 12 months, and we adjust the depreciation that way. Okay, so it seems most people are either asleep or understanding, hopefully the former and not the latter. And I forgot to say, but I'm sure this is obvious because this is how we work. All what I'm reading and where I'm going with this example, it's all over here already on the Zoom notes and materials. This is the spreadsheet that I'm going to use now to do calculations with you. So if you're in Blackboard, you should have already been able to see this stuff. If not, I can give you guys, or you can take a minute where we'll do a little bit on this example and then we'll take a break. Okay, I'll probably read the example, we'll take a break, and we'll go on with it when we come back from break, at which point you might also want to download anything that you don't have. So I set up 2 depreciation examples to take us through the different types of depreciation, and also like thinking about depreciation methods and doing the journal entry, doing the balance sheet, and then also doing a partial period depreciation example. I set up both, one will be for me to do with you, and another one can either be extra practice for you, or depending on how much time we have, we may tackle it again before the test or whatever. So just reading the question here, on January the 1st, 2013. So we're starting at the beginning of the year for this company. Stanley Coal Mine purchases an additional crane. So they bought an asset. The crane is classified as equipment. So that tells you that on a balance sheet or in a journal entry or whatever, if you're doing the entry for the acquisition, you're going to debit equipment, and on the balance sheet, you're going to show the account name as equipment. The following information relates to the crane. The crane cost 500,000. Now remember what we spoke about at the beginning of, what information we need in order to calculate depreciation. So we need the cost. So the cost is 500,000. The useful life is 5 years. So that's also information that we needed. Estimated salvage value, which is the same as residual value. The book also calls it residual value, is 50,000. This represents what the company thinks they will get back at the end of the 5 years. So this is an amount that we do not depreciate. And depending on the method that we use, we either subtract this amount from the cost to get to the depreciable base, or we only depreciate up to a book value that is equivalent to this amount. Productive life in hours. So normally, for the most part, we won't necessarily in real life, right, get given a useful life in years and in hours, but because we're also going to do units of activity or units of production, it means the same thing, calculations, we're also being given an hour's life, and then it tells you how many of those hours were used in the first year, year 1, which is 2013, and in year 2, which is 2014. Okay, so that's the setup. And when we come back now from break, we're going to calculate depreciation expense for 2 years using the different methods. I'll show you how, and then answer the rest of these questions. So by my watch here, it's 11:28. So let's say, just in case the clock turns over, let's say we come back 11:39, okay? And so take the break, and during the break, if there's anybody who needs help with anything, I'm here. And if you need to get a hold of these pages or something so that you can see them or log in to see the classwork, do that during the break. Just excuse me for a minute. I'll be right back.
Professor?
Yes.
Yeah, can I ask you about the writing assignment for now, right now?
Yeah, we have like 4 minutes. So is it going to be a quick question or do you
Yeah,
want to
yeah,
wait? And okay, go ahead.
yeah. So I'm I'm working for the writing assignment. So as you said, is it possible to submit if I haven't finished whole items? So
Yes, yes,
yeah,
yes, it is. You can send me whatever you have, and you can just tell me in the email in a note that you haven't finished, but you've written up to this point. That's fine.
okay, thank you so much.
Mhm. All right. So we're back from break, and we're going to tackle this question. We start with number one, asking us to calculate all the different types of depreciation. And so I'll just go back to again, this document, this Google Doc is a link pasted into and you should have access to it because I made it anyone with a link as the access setup. So what I usually do with questions like this, just to keep my wits about me, is that I put down the major factors, right? We know that we have a cost of 500,000. We have a residual value or salvage value. It means the same thing. I think the book calls it the residual value, but it's the same thing. And so that means that we have a depreciable base, which is equal to the cost minus the salvage value. So this depreciable base and so on is going to apply to quite a few of these methods. So it's best to just calculate that right at the beginning and have it at the top, so you don't have to keep recalculating the amount and opening yourself up to potential errors, right? Especially if all of these things are using the same, all of these methods are using the same numbers. So the first method that they ask us to calculate is the straight line method. And so I'm just going to put that as a heading so you know what we're doing. And this is like really easy because, oh, I'm sorry, I forgot to put that the useful life over here. So I want to put this. I don't know that I want to put this here. I'll just put it over here because it actually applies to this method. So useful life is 5 years. So all you do is you say, what's the depreciable base? It's Monday blues with my typing, right? Divided by the useful life. That's the, I know you guys already know this, but we're just being very clear. So it's going to be the 450,000 going up, right? The 450,000 divided by 5, which is also just do equals, and it should be 90,000, but I'll just do the calculation. So it's $90,000 per year, and it's going to be the same for all the years. So, this is again the point about straight line, that it's just the same. So that means, remember the question was, what's the depreciation for 2013? That's 90,000. What's the depreciation for 2014? It's the same. Questions? Too obvious, right? You guys are beyond these points. So just a note here, because it's going to come up when we do declining balance. Straight line, right? Straight line, useful life is 5 years, right? But this can also be expressed as 20% per year, because you're saying 100% of the asset over 5 years is the same as, so it's 20% per year depreciation. I just want you to remember that, because again, when we come to declining balance, it might tell us that it's double declining balance, which when they say that, it means double the straight line rate. Okay, so we used the number of years, but you could also be told that straight line is 20% per year. You'd end up at the same answer. All right. Now B, and stop me at any time if anybody has questions here. So this is going to be units of activity, or I'll go with what the book calls it's units of, people change the names for whatever reason from time to time. Units of activity or units of production, right? So here you want to first calculate, the step one is to calculate the depreciation rate per hour, because you're saying remember this question told you that the useful life in hours, 30,000 hours. So you want to know for every hour that you use the machine, how much depreciation, right, should be expensed. So we're going to have a formula for that, which is, handy. The formula is going to be the depreciable base of the asset, which we've calculated above, divided by the total productive hours for the asset. That equals the depreciation rate per hour. So if we want to calculate that, obviously the depreciable base we have over here, it's 450,000. Let me do this. So that equals 450,000. It's 30,000 hours is the total life of the assets, right? In terms of the hours that of production, or however you want to call it. And so this is a little bit far away. Okay, so we come out to 450 divided by 30,000, $15 per hour. Now, sometimes people will just stop there and say, okay, that's it, kind of thing. That's not it. That's not the depreciation expense. Remember, that's the question was, what's the depreciation expense for these 2 years, right? So $15 just tells you how much you depreciate per hour. Now you have to actually do the calculation for each of the years. So it's 2013, the question tells you that you did 4,000 hours. So you're going to say equals 4,000 times 15, okay? So again, so depreciation expense, and in case you didn't see what I did, 4,000 hours times $15 per hour. So that's the expense for that year based on the actual activity, not based on just, the useful life in years like the one before. And then for 2014, it was only 4,000, sorry, it was 6,000 hours. That one's bigger, 6,000 hours of 6,000 times 15. So 90,000, right? That doesn't mean that the methods are the same. Just because this is 90,000 and this is 90,000 doesn't really mean anything like that. It's just saying that based on the number of hours, we actually end up, okay, I can't do that. Can I? No, it's not letting me. I thought I could be lazy, but now I cannot. Okay, so depreciation expense is 6,000 hours times $15 per hour. So when you guys look at this, you'll know where I got these numbers. All right, so that's units of production or units of activity, something something that you have seen, I'm sure, before, and is not maybe too difficult to follow, but I must open the floor just to make sure that no one has any questions. Anybody want me to explain something again, or I don't know, have some type of discussion over something that was done here? Okay. So now we move to the kind of weird method, sum of the year's digits, a little bit strange. Sum of the year's digits. So as the name implies, you have to do something to do with adding up the sum of the number of years that the asset's useful life is. So we start by calculating the denominator, the bottom number, for the fraction we will use in the depreciation expense calculation. The denominator is the sum of all the years in the life of the asset. Okay, this asset has a useful life of 5 years. So we will say 5 plus 4 plus 3 plus 2 plus 1 equals 15. That's how we come up with the denominator. That's what they mean by the sum of the years. Okay, if the asset's life is 5 years, you say 5 plus 4 plus 3, write down to 1, and you come up with 15. If the asset's life was 10 years, you would say 10 plus 9 plus 8, and so on, and add all those years together, and that gives you the bottom number in the fraction, the denominator. Okay, the numerator, right, the top number in the fraction, in the fraction is the number of years left in the asset's life at the start of the year for which we are calculating depreciation. So for example, an asset with a 5-year useful life will have 5 years of life left at the start of year 1. So the numerator is 5, and so on. So I'll show you. So think about that for a second, because it's a little bit wild, right? You may or may not have seen this before, and it feels like it shouldn't work, but it does. So you start off by calculating the denominator by adding the sum of the years that are in the life of the asset. And there is a small formula, I think it's in the book. I can show it to you to make it easier. It's like an n, over n plus 1 or something like that. I can't remember, but I can show it to you there's a formula to do it, or you can just add the numbers on your calculator. And then for the numerator, you always need to just be using the number of years left at the beginning of the asset's life, not at the end of the year, but at the beginning. So I'll show you now what I mean. So for 2013, for this asset, what we're going to use is, or let me say, actually the formula for this thing is the depreciable base again. See how we use the depreciable base many times, multiplied by the fraction, that you calculate as described above. That's the formula. So for 2013, you're saying 450,000, that's the depreciable base, and you're multiplying it, watch this now. In 2013, that's the first year of the asset's life, so there's still 5 years left. You assume that you're doing this like at the beginning of the year, for the year. So 5 years of life left divided by 15 years is the sum of the year, or 15, excuse me, not 15 years, 15 is the sum of the year's digits. That gives you a depreciation expense for that year of 150,000. So that's how you do the first year. Now think about how you would do the second year, right? At the beginning of the second year, 1 year has already gone away. So you still use the same depreciable base. That doesn't change. But instead of saying 5, you say 4. And with this method, people have how can you say it? Like, people have a temptation to put 14 or 13 or something like that instead of this 5 and 4 and 3 and 2 and 1. But remember, if you had to carry this depreciation right through to the end, the numerators would, like, it's 5 15s, 4 15s, 3 15s, 2 15s, 1 15s, they will add up to 1. All right. So you don't want to start fiddling with this thing and making your own fraction. This fraction is, it's kind of defined how this fraction looks. Okay. So every year you just do whatever number of so I just want to remind everybody that this is now the depreciation expense. Every year you just use the number of years that are left in the asset's life at the beginning of that year. If you had to calculate this on, I'm not going to do that because it's fairly obvious, but I think in the book I was kind of just checking. I think in the book they have one, let me see. Yeah, see this. So there's the depreciable base is always what is being used, right? The 210,000 in this, and there's the formula I was talking about. You can use this formula to calculate the sum of the year's digits. If it's a 20-year life asset or something, you don't want to sit there going 20 plus 19 plus 18 plus whatever and driving yourself crazy to check if you actually included all the numbers. So there's an n times n plus 1, n being the number of years in the useful life of the asset. This asset is 5 years, so it's 536 divided by 2, and you still come out to 15. All right. So look here, the depreciation rate per year: 5 out of 15, 4 out of 15, 3 out of 15, and so on. Eventually, it adds up to 15 fifteenths, which is 1. So that means you did in fact depreciate the entire asset. This is your depreciation expense every year. Comes up to the same as the depreciable base, as it should, because you're multiplying it by fractions that add up to 1. And then the accumulated depreciation is just the prior years plus the current year, right? Accumulated by its name means that the number's growing. That should also be equal to the depreciable base. And then, of course, in this question, we didn't go over the question, but I can tell that the residual value of this asset, I can't see where it's written, but it's here, that the residual value of this asset is 40,000 because of the associates. 250,000 was the cost, and then we only depreciate to 10 because the residual value is 40. So obviously by the end of the depreciation process, you're still left with a 40 because that's what you expect to recover at the end of the asset's useful life. Anybody have questions here? Okay. So that's some of the year's digits. Now we come to declining balance, which is calculated a little bit differently from the other methods. Please note that it says use double the straight line rate, which is also, oh yeah, go ahead with your question. Sorry, I probably didn't give enough time for question. Go ahead.
Okay. For the sum of the year's digits, I was wondering if it's by months to months, or not the year. If it's not the year, it's only the year.
Yeah, it's the year.
Okay.
If you, yeah, it's the year. Where you may run into months is if you do partial periods. Let me see if it's in this section or in the next section where there's, yeah, so it's only years. First of all, let me be clear with that. I just want to see, for the partial, I know that when we do partial period, there's a little bit of discussion around how to do the different methods with partial periods. So let me see, do they even cover it? And they do straight line. They do. Yeah, I mean, I see that they don't, I think the sum of the years digits is just the sum of the years digits with the years, but you could probably still apportion it. Like, let's say you only bought the asset in September and you only use it for 3 months. You could probably still apportion the answer that you get, right? Let's say the answer is 150,000. You could still apportion that for 3/12 or something like that. But do you use months over year when you add up for the denominator? No, you use years. Have I answered your question?
Oh yeah, I see. Thank you, Professor.
Okay. Anything else, guys, before I move on? All right. So double declining balance method is often how they call it. And when they say double declining balance, you're supposed to know that it means double the straight line rate, which is not obvious if you haven't read the book or you don't know, that this is something that's often said. You'll be like, double what, right? So it's double the straight line rate. So remember earlier, I told you we should calculate what the straight line, and by rate, I mean percentage. What is the straight line rate? It's 20%. So in this question, what they're trying to tell us is that the declining balance method will use a rate of 40% because it's double the straight line rate, double declining balance. So already, at the beginning, before you even started anything, you would have to have that information. So this is declining balance method, and the rate over here is going to be 2 times 20%, right? And the 20% is the straight line rate equals 40%, right? That's how and the formula for this is going to be the book value at the beginning, not the end, right? At the beginning of the year multiplied by the rate. So notice that this is book value, not depreciable base. So it's a whole other story. This is not going to be the 450,000 that we've been using for all the other methods. It was easy, right? We just kept using the same 450,000. Book value is a defined term. Book value is defined as cost minus accumulated depreciation. So that's what we will use to calculate declining balance. All right, so let's see what we have to do for 2013. So it's a book value at the beginning of the life of the assets, right? Let's think about that. Book value right at the start. Book value on day 1 is the same as cost because no depreciation has occurred, right? Oops. So over here, when we do the first year, we're going to say 500,000 is the cost minus 0 accumulated depreciation equals still 500,000. And we're going to multiply that by 40% because we're using our formula, the book value at the beginning of the year multiplied by the rate. And so for the first year, the depreciation is 200,000. Notice how the 200,000 is massive compared to straight line, or I mean, it's pretty big also compared to units of activity. which was 60,000. Straight line was 90,000. It's more than double that. Some of the year's digits is also bigger because some of the year's digits is an accelerated method, but declining balance is by far the biggest amount of depreciation being expensed. Remember that these methods, the accelerated methods, are expensing more depreciation at the beginning of the life of the asset, and over time the depreciation expense will go down, right? So it's not going to be this huge forever, but certainly starts off huge. And so for 2014, you're going to say what's the cost is 500,000 minus the accumulated depreciation at that point is 200,000. So that gives us a book value of 300,000. You multiply that by 40%. So you end up with 120,000 depreciation expense. So you see already just between year 1 and year 2, gosh, my typing is all over the place today. Just between year 1 and year 2, you end up with already a drop of 80,000 in the depreciation expense. So, it's accelerated depreciation starting big, and even with that drop, the 120,000 is still double what you had for, almost double what you had for units of activity or units of production, and it's certainly bigger than the straight line method. So this is accelerated. And I mean, if you want to know how to keep going, you just, keep subtracting, and maybe I'll show you 2015 because it's important to at least see 2 years worth of accumulated depreciation. So you're saying 500,000 at this point, minus the 200,000 from 2013, minus the 120,000, right? So it's 320,000 of accumulated depreciation that you are that you're taking off to come to book value. So 500 minus 200 is 300, minus 120 is 180. So now your book value has gone down to 180,000 multiplied by 40%. How much is that? Is anybody working with me? Otherwise, my brain is not so fast today. I'm gonna have to just resort to a calculator. So 72,000. And so we go on until you have to limit, and I'm not, and maybe I should show this, I don't know, I don't want to bore you guys, but basically we continue to depreciate. I'll just write it here. We continue to depreciate until the book value is equal to the salvage or residual value, right, of, in this case, 50,000. Even if we have to limit the amount of depreciation expense in the final year. Does anybody want to see me? You can raise your hand if you're interested. Happy to do it. Does anybody want to see me take this right through until 2017, the last year, so that you can see how I limit the depreciation? If I see one hand raised, I'll do it. If there are no hands raised, I'm happy to not do it. Either way is fine with me. Okay, so seemingly we're okay. So that was D. And now number 2, I'll ask you to think about this and maybe someone can talk us through it. Which depreciation method should management choose and why? What do you think? Which depreciation method should manage? There's no wrong answers here, okay? It can be any method. So which method do you think? I need someone to raise their hand and talk to me. Which method do you think management should choose out of the 4 based on what we just saw, and why?
May I say that?
Yeah, go ahead.
I think management would prefer to choose the straight line method. This is because this method is very easy to calculate, and also the price will be cheaper than others.
Okay, so every year the expense is less, you mean?
Yeah.
Oh, yeah, and it's the same. Thank you. So straight line, it's easy, it's predictable, it's lower than, I mean, it may not be lower than units of activity depending on what happens, but it's certainly lower than the accelerated method. So you're getting a little less depreciation every year. Thank you. And what you're saying bears out in, and now I've lost my place, but that's okay. I'll just find it again. What you're saying actually bears out in practice. I hope I can find, yeah, bears out in practice, because look at this, right? Look at what the companies use. Do you see overwhelmingly companies use straight line method as their depreciation method? Remember, I mentioned that even Peloton, I've gone away from that footnote now, but remember Peloton said that they use straight line depreciation for property and equipment because, I mean, they don't say because it's easier, but we know that it's preferable because it's kind of almost automatic, because you're just like, yeah, it's the same thing over and over. So we'll see later in the chapter that companies can change their depreciation method. They can change from straight line to declining balance, or some of the S digits, or whatever change they want to make. But even then, when they make that change, they'll just do it for the current period and going forward. They don't have to, do it going back, but they do have to explain if they make a change, why they're making a change, because, sometimes, just like to what Gion was saying, there is a financial implication, like straight line has less depreciation going through than, say, some of the year's digits. So a company may see, oh no, our profits are going to be lower this year, so let's just change to a different depreciation method so that we can look a little bit better, we can make an earnings target. That's not a good enough reason to make a change. So again, overwhelmingly, companies use straight line, some use other methods. If a company decides to change from one method to another, they have to justify why they're making that change. So when you look at financials, whether with me or in your future accounting classes, you'll probably notice for the most part in the footnotes that companies use straight line method. So then you should say, well, why do I have to calculate, these other methods, right? And part of the reason is you could end up in the two companies that are some of the year's digits, right? Not just that, the stuff comes up on the CPA exam. They don't say, oh, because 490 companies out of whatever, 550 companies use straight line, we're only going to test you on straight line. They'll test you on anything. So we as accountants need to know how to do anything. And we need to be able to talk through the reasons why we would choose one method over another. If you don't know how some of the year's digits works, then if your boss comes up and says, which method should we use, you won't, between these methods, you won't be able to make that decision. Other ways that we could answer that question, we could say that units of, someone might choose to use units of activity because it's, closer to the actual use of the asset, so it's more accurate. I'll write down a few answers, to answer that, but I'm kind of with Gion that straight line is probably where it's at for a lot of companies, just because it's just so easy. Okay, so here's some of just the thinking behind the different methods, right? It's a straight line is a consistent amount. Sorry, it's predictable, it's simple, right? There might be more things that you could say, but it may or may not be less than the others. I don't want to say that it's always less than the others, because units of activity could be less, right? Units of production or units of activity, however you want to call it, the depreciation, it's kind of a little bit more accurate, because depreciation is based on actual use, right? But not as simple, right? Not as simple as straight line. Because you got to go, not only, I mean, I give you the information in a class and the book gives you, but I mean, in real life, you got to go find the stuff. You can go find out the mileage on the truck, and you got to go find the number of units that an asset produced, etc. So, I mean, it's not that easy. So then sum of the years digits. I'll just read out the some of the years digits. I mean, it's supposedly higher, right? Not supposedly, I mean, it does have higher depreciation, supposedly in the years where the asset is more useful. I mean, I'm not saying we do some of these digits on phones, but I mean, if you think of a cell phone, I mean, sometimes we almost think like these cell phones are built to break in a way, because, after 2.5 years or whatever, they're basically giving all kinds of problems. So if you had to depreciate the phone, you would say even a computer to some extent, that it's probably most useful in the first, 2 or so years than in the later years. So it's higher depreciation in the years where the asset is more useful, could meet tax, I'll just call it tax planning goals. Maybe people want more expenses in the earlier years, but it is not, sorry, I see that I made a mistake here. This is also not as simple. Also not as simple as straight line. It's in fact more involved, right? And then the declining balance, it's going to be very, you're possibly matching expenses or depreciation expense. Possibly matching depreciation expense better, right? Better to revenue. Helps with tax planning, possibly, right? Also not as simple. So when you start just looking at things, you realize that, companies are probably just going to go with whatever is easiest, even if it's, because we all know that depreciation is just an estimate. A lot of the analysts that do valuations of companies use what we call EBITDA. So they use the earnings before depreciation and amortization anyway. They don't even factor that in because they know that it's an estimate and that it's probably not the true amount of an asset that's being used up. So, companies are probably less concerned with having a number in there that is like to the penny, because it's not possible. All right, so those are some of the thoughts around, if you were asked in a written question, which method might be better. Questions on any of this that I wrote here? I mean, I kind of just went off and wrote up a whole lot of stuff, but does anybody have anything they want to add or any question that they may have about it? Okay, doesn't seem like it. Now we got to do a journal entry for depreciation under the straight line method. This is, a classic journal entry that you'll probably remember: debit depreciation expense, credit accumulated depreciation. You just got to remember that it's for straight line. So you got to use the dollar amount for straight line, which is 90,000, right? 90,000. So here goes the journal. Nothing groundbreaking here. Remember debit and credit. So this is a debit to the expense and a credit to the contra asset. And if you put accumulated depreciation dash equipment or whatever, that's fine. But that's it. Nothing else happening there, just to refresh your memory about the existence of this journal entry. Show the balance sheet, property, plant, and equipment disclosure for the asset and accumulated depreciation under the straight line method. All right, so now we're taking it to the balance sheet. That's fine. All right, so a balance sheet, we have the name of the company, it's given to us in the question, right? So name of the company, we usually do the name of the financial statement. We know that a balance sheet is at a point in time, so it's just going to be a date, not for the year ended. Then we know that this stuff is all going to be part of the broader topic, or not topic, the label of assets. And within that, you're going to have a subtopic of, or subheading, I should say, broader heading and subheading. I don't know, I'm losing my words now. Property, plant, and equipment. And then we'll put equipment. Remember, it said in the question that this crane would be classified as equipment, so I'm putting equipment, right? And the cost goes over here, 500,000, okay? Not the depreciable base, the actual cost, because this is coming from the general ledger into the trial balance and into the financials. And in the ledger, equipment is carried at 500,000, okay, not 450. The subtraction of the salvage value from the cost of the asset is just a factor of depreciation calculation. It's got nothing to do with the cost of the asset actually going down. And then we say less, and we take off the accumulated depreciation. Remember, they asked us for the straight line method, so it's just going to be the 90,000 from that first year. And then you can draw a line, and you come up, oh, I put it in the wrong place. You can draw a line over here, and you come up with 410,000. And this is also known as the book value, right? The book value, or the carrying, sometimes also referred to as carrying value. They all mean the same thing. Book value or carrying value of the asset. All right, so that's the 2013 balance sheet for this asset. If I had to say to you what's happening in 2014, I'm going to give you 2 minutes here until 12:20 to think about it for yourself. How does this balance sheet look at December 31, 2014? All right, based on what you know from the calculations we've done so far. So 2 minutes to figure out 2014. All right, does anybody want to throw it out there, the answer? You're welcome to just say what you want me to write down for 2014. Crickets. Okay, I'm not gonna call on anyone. I'll give you guys a pass because I'm assuming that people are not actually engaged or not knowing what I'm asking. So by 2014, this is really not that difficult. You're just adding up the 2 years worth of depreciation. So it was 90,000 in 2013, 90,000 in 2014. So accumulated depreciation is 180,000. And we have a carrying value or book value of 320,000. All right. And so it would continue for the remainder of the years until you get to the last year at which the accumulated depreciation will be 450,000 and the carrying value will end up being 50,000, which is the same as the salvage value. All right. So that's the balance sheet presentation. Now, of course, if you should be saying to me, but when we look at, a Peloton or some other company's financials, we see that they just show one line on the balance sheet. They don't show all the subtraction. That's true. They just have so many assets that in the end, they just show the information with the subtraction and so on. They show it in the footnotes. I'll see if I can go back to that footnote that we were looking at earlier. See if I can find it. It might be a little bit difficult to do. I think that was page 88, but bear with me. All right, that's the net assets. Okay, there. So over here, you can see they're doing that. They're putting down all the assets and then they're putting the accumulated depreciation and amortization. And then they take this ending number to the face of the balance sheet, because if they had to list all of these assets on the balance sheet, it would become really long and really confusing to people. So they say, okay, this is the number, the net number, but you can go to the footnotes and see what it consists of. So what we're doing here is, because we're assuming that the company only has one asset, and we're just showing that one asset on the front or the face of the balance sheet. We don't have to show it in the footnotes. Okay, so the last thing here to do is number 5, and this is a partial period calculation. It's saying if the asset had been purchased on April the 1st instead of January the 1st, show the calculation for 2013 depreciation using straight line. So if it's April the 1st, right, then you have to think how many months from April the 1st to December the 31st, because remember, you can only depreciate once the asset is in use. So you can't do a full year's worth of depreciation if the asset was purchased sometime during the year. So April, May, June, July, August, September, October, November, December. So it's going to be 9 months out of 12 months, right, that the asset is going to be in use for. So all you really need to do now, let me give myself just a little bit more space, is, you're doing straight line. The asset is purchased on 4/1, right? So for straight line, you're going to say 450, you're still saying 450,000 divided by the 5 years is 90,000, but that's for a whole year. And that 90,000, you're just going to multiply by 9/12, right? This is easy stuff. It gives you the 67,500. That's so for an asset purchase at that point in April, instead of expensing 90,000, you'll just expense 67,500. Questions on anything, because we're done with this example. Anybody need me to go over anything again? Okay. So going back to the notes, we've now covered all of the depreciation stuff and the partial period depreciation. I'll come back to disposals for a second. I just think that the book has disposals before they have group and composite methods, but I'll just go over this group and composite methods. It's not a big topic. It's just to kind of let you know what may happen in practice. Some companies have such a massive amount of assets that they actually use like a group method of depreciation submission for the whole bunch of assets, just to, and I believe there's a visual, or I mean visual is probably not the best word, but there's at least some type of illustration, yeah, in the book here. So yeah, you can see what I mean. They're putting a group of assets together, and depreciating the group, even though they have different useful lives and so on. We're not being called upon for our class for you to calculate this. You just need to know that this is a possibility. There's all kinds of diversity in practice in terms of what companies do. So the group and composite methods involve averaging the service life of many assets and applying depreciation as though all those assets together are a single unit. So to go back to this, they're treating the vans, the trucks, and the wagons as one unit, or one asset, and then averaging their useful lives to come up with a depreciation rate. The group method is used for similar assets. You can tell it's vans, trucks, and wagons, so they are similar. The composite method is for assets that are not similar, but they're still being depreciated together. And then the biggest thing, I think, yeah, besides the fact that they're averaging the useful lives, which is a big thing, when you use a group or composite method, when an asset is retired, any gains or losses don't go to the income statement. They just go back to the accumulated depreciation account. And I suspect that the book doesn't talk much about why that is, but I suspect it's just because this is a method that is such a combo of items that probably the gain or the loss is not maybe as accurate as it would be if the item was being depreciated on its own. So maybe you're not allowed to recognize things in the income statement because it's not known with how accurate they are. And as we said, the depreciation rate is calculated specifically. You can see here the group depreciation rate is the depreciation per year divided by the total cost of the assets. So they come up with 16%, and that's what they will use. So that's what this is talking about here. There's never a gain or a loss on a disposal of the asset when the asset is being depreciated as part of a group or part of a composite. I'm just trying to see if they do composite as well. It seems like the group and the composite is very similar anyway, so it's fine. So that's the way it looks. And then the other thing to remember is that companies can also make up their own depreciation methods. Make up is probably the wrong word. They may develop something that is, it's not like makeup, like I just want to, depreciate this thing over, 1.35 years at whatever this is, like, not like that. It's more that there are methods of allocation that don't necessarily fit nice and neatly into straight line or units of activity or whatever, but companies can use a method that works for them as long as they are doing it right systematically and rationally, as the the theory tells us that you and consistently, I guess, is part of the systematic. So if you run into this when you go and work somewhere, obviously you should ask if someone's using a depreciation method that seems a little bit wacky or whatever. First make sure when you speak to them that they are like what the method is, find out the origins of the method, and then obviously make sure that it's being systematically applied. But for the most part, it's because depreciation is an estimate, and we do have methods that are kind of quote unquote approved, but it is possible that a company could use a method that maybe is not as cut and dry as some of the 4 methods that we just went over. All right. So that's the thinking around groups of assets that companies may have. They may literally just average out the depreciation and the cost to get to a percentage and just apply that percentage across the board. So if you see something like that in practice, you shouldn't come running to your textbook or whatever and say, oh my goodness, this is wrong. Well, not to your textbook, but running to your boss, I should say, this is wrong or something. No, make sure that this is something that is rational, it makes sense, and that it's being applied consistently. All right. So the last thing that we'll talk a little bit about today before we leave is what the book refers to as dispositions, or which is really disposals, which we've come across a lot already. But we speak about disposals in the context of this chapter because we're doing depreciation calculations and dealing with book value and things like that. And when we dispose of an asset, we end up calculating depreciation also up to the point of when the asset is going to be sold. So that might even be a partial period calculation. Right. So after using property, plant, and equipment, obviously the company will sell or retire. Retiring the asset just means that you're not actually getting any consideration for it. You're not getting any cash or other assets for it. If the assets are sold, a gain or loss will be recognized, and that the way we calculate that gain or loss is the difference between the selling price or whatever is received for the asset and the asset's book value, cost minus accumulated depreciation. So I repeat, that's the formula for gain or loss is the difference between the selling price or whatever consideration is received and the book value. Cost minus accumulated depreciation tells you if there's a gain or a loss. You have to calculate depreciation up to the date of the sale. So if the asset is being sold, sometime in the middle of the year or whatever, you can't just say, oh, we since the asset is being sold during the year, we don't have to worry about depreciation. No, because book value goes into the calculation of the gain or the loss. The book value has to be accurate. So the calculation for depreciation has to be right up to the date of the sale. Like I said, retirements are also obviously a type of disposal or disposition, but a retirement is just where you don't receive any selling price or consideration, right? And depreciation calculations may also be changed if an asset is being retired, especially if the asset is being retired sooner than expected because of some change in estimates. And we will get to changes in estimates for depreciation and calculations around that next time when we get together. This is straight from the textbook, but I just reproduced it here so we could talk it through. The formula, selling price less the book value, so cost minus accumulated depreciation gives us the gain or the loss on the sale. And I didn't put this example in here in my notes because it's it would be too long-winded, but we could go through it up to a point and I'll see what time allows. So illustration 11.7c, you can go and look at it yourself again. I'm just trying to use some of these examples in the book because they're decent and also they're so long that putting them in as an exercise at the back of our notes is a bit of a process. So on January the 1st, 2021, Hogan Manufacturing Company purchased a machine for $250,000. The company expects the service life of the machine to be 5 years, so there's a useful life. The residual value, salvage value, is $40,000. So the depreciable base for this asset would be $250 minus 40, so $210,000. We kind of saw this example before. It's the same asset that we were looking at when we were looking at the example of some of the year's digits. Hogan uses straight line depreciation method for machines recorded in the equipment account. So it's obviously 210,000 over 5 years. Suppose Hogan does not hold the machine for the expected 5 years, but instead sells it after 3 years for 140,000, right? So 140,000 is the consideration that's being the selling price, the consideration received. We first need to update depreciation to the date of sale. All right. Since depreciation for 2021 and 2022 has already been recorded in those years, we need to update depreciation only for the current year for 2023. And so they made it easy because they made the sale right on the last day of the year. So all you're doing is taking the depreciable base, 250,000 minus the 40,000 is 210, divided by the 5-year useful life. Every year's depreciation is 42,000. So when the sale is about to happen, You calculate depreciation for the period of time that is not yet accounted for up to the date of sale. So what they're saying is with this asset, every year they've been charging 42,000, right, to the accumulated depreciation account up to the date of the sale. So 126,000 is accumulated depreciation. So now let's see how we calculate the gain or the loss. Right, the selling price was given in the question as 140,000. The cost of the asset is also given in the question as 250,000. So 250,000, pardon me, minus the 126,000 of accumulated depreciation gives you a book value of 124,000. And the 140 selling price minus the 124,000 is the 16,000 gain, right? Gain on the sale of the asset. And if you want to see what and this is, I mean, it's a typical disposal journal entry. You have to record the cash that you received. You have to remove the asset. You might remember this from when we did non-monetary exchanges, but sometimes there was also money involved. You record whatever the consideration received. You remove the old asset. You remove the old accumulated depreciation, and you calculate and record a gain or a loss. So in this case, you debit cash for 140,000 because that's what you received. Accumulated depreciation up to the date of the sale is 126,000 that you debit, obviously, because accumulated depreciation is a contra asset, so it has a credit balance, debit to get rid of it. Equipment at 250, credit to get rid of the debit balance, and then the gain that you just calculated is 16,000. So all the balances relating to that equipment will be zero after the entry, and of course the gain on sale is going to be part of other gains and losses in your income statement. And so when we're talking about, you know, dispositions, as they call it, or disposals, that's really what, you know, what we're talking about. And if they sold it for below, not below, for less than the book value, let's say they sold it for 110,000, then obviously the journal entry just will change to a loss. But let's just talk it through. Then the proceeds are only 110, but the book value is 124, so there's a $14,000 loss. You still record the cash, you still record the accumulated depreciation. You now just have a debit loss of 14,000, and the only credit is the cost of the asset. And again, everything related to that equipment is removed from the books, both the cost and the accumulated depreciation. Is there any question here about this disposal example?
I'm good, Professor.
All right. Okay, so I mean, maybe just to look at the last thing here, when it comes to dispositions, there is some information around assets that are held for sale but haven't been sold yet. And I'm not going to ask you, you know, what are the 6 criteria, but there are 6 criteria that allow an asset to be qualified as held for sale. So, you know, just because you want to sell something doesn't mean that it sells immediately in the period. And so you could actually end up with your year ending and you still have assets that are held for sale in your company. And you know, there's a few rules around that. You no longer depreciate or amortize those assets that are held for sale because they are not in use in the company. So let's say we have a piece of machinery, we are trying to sell it, we're no longer using it because we're trying to sell it. And so it's sitting over there on the factory floor. We're not going to charge depreciation for that machinery because it's not in use. Remember, depreciation is a factor of use. And if it's out for sale, you're going to measure it at the lower of the asset's book value or the asset's fair value less cost to sell. So this may ring a bell or it may not, but I'll tell you which bell to ring from chapter 9, where we did lower of cost or net realizable value on inventory. This is kind of a similar thing because we're saying we know that we want to sell this asset. And so we look at what's the fair value, so how much we could sell the asset for, less the cost to sell the asset, and we compare that to the book value that we are carrying it at. So obviously, if the fair value less the cost to sell is less than the book value, then it means that we have a problem, we have a loss on our hands, and we have to recognize that loss immediately in the period when it happens, right? So this is again GAAP trying to make sure that companies are recognizing losses when they happen. So, when you think of assets held for sale in this context, think about, kind of the inventory at the lower of cost or net realizable value, and the fact that you have to take a loss if net realizable value is less than cost. And if you are still holding this asset for sale when maybe the quarterly financials have to be prepared, you have to look at the fair value of the asset again, minus any selling costs, and compare that to what you are carrying the asset at in your books. And maybe as time goes by and the asset becomes less and less useful or less and less popular, maybe the fair value is dropping, you need to account for those drops every time you prepare financial statements. And if suddenly the fair value goes up, right, since the previous time that you measured it, you recognize that gain, but only up to the point of any losses that you have recognized previously. So let's say you took a loss of $10,000 in the first year, and in the second year, the fair value goes up, but the fair value goes up by $50,000, you can only record a gain of 10,000. You can't record a gain of 50,000. You can only record enough gain to wipe out the previous loss. And any other gains that you make, you'll have to realize when you actually sell the asset. So we're back to that classic approach with the FASB, which you guys should see by now, how it always comes to the same thing. You always recognize losses in the period when they happen, right? Regardless of, even if you're still holding on to the asset, you have to pick up the loss. For gains, normally you don't anticipate gains and recognize them before there's a realizable event, but in this case, you can recognize some of the gains, but only enough to wipe out any previous losses so that you end up on zero, right, square. You can't recognize gains past the point of the losses that you previously recognized. So if in the first year you look at the fair value less the cost to sell and it's higher than the book value, you will still carry this asset at book value because we don't write the assets up to fair value. We only write down to fair value. This is a massive contrast for those who are interested, and maybe you're going back to your country to work or whatever. For those who are interested in international accounting standards, international accounting does allow write-ups to fair value. GAAP does not. It only allows writing down to fair value. It's still a very conservative approach, and they value, I guess what they're saying is they value reliability over relevance, because fair value is more relevant, but obviously the fair value number is based on some assumptions. But I guess the international accounting folks have reconcile themselves to the fact that there may be some assumptions, but they're okay with that. So think about that, right? As smart accountants, what does that mean for companies that are operating in different countries? Where do they report? If they report in the US, if they're listed on the New York Stock Exchange, they got to go by US GAAP, but they're getting numbers coming in from different segments and different parts of their business that may be on international accounting standards. Maybe it's businesses that exist in those companies, but they're part of the family of companies, and then you have to convert those numbers to US GAAP. I used to audit a bank like that had operations in South Africa, which was international accounting, but also had operations in other countries on different accounting standards, and they had to do a reconciliation to get everything to international accounting. It's a lot of work, but it's also very interesting. All right, so I'll leave it there. And next time we'll go into depletion and amortization and impairment. And I'll stick around here if people have questions for me, but if not, go and have a lovely day. Don't forget that the chapter 10 homework is due at 6 p.m. today, and I will be on office hours at 1 p.m. this afternoon. Bye. Have a great day.
Thank you, Professor. Have a great
You're
day.
welcome.